Hello dear students, this is Dr. Yashi Tiwari from Department of Commerce. I am here to take a new topic of derivatives. Derivatives, not the one that is there in mathematics, but derivative market in financial management. We would be covering few topics here related to derivative market, that is its meaning, its advantages, disadvantages, participants in derivative market, and the last that we will be covering is types of financial derivative. Now, let us understand what do we mean by derivatives. Okay, talking about the meaning. As it is mentioned here, derivatives are financial instruments whose value is derived from the value of another asset which is known as underlying. Understood something? Honestly, nothing. Let us break the definition. One important term is financial instrument. Another important term is underlying. Now, when I say financial instrument, I say any asset which can be traded. All of us know what is an asset, very true. Traded is something that can be bought and sold. Then in that case, I can say stocks, bonds, debentures, FDs. So, are all these financial instruments? Stocks, an asset, yes. Can be traded, yes. Bonds, asset, can be traded, yes. Debentures, asset, can be traded, yes. FDs, asset, yes. Can be traded, no. Alright. So, here we understood what do we mean by financial instrument, right. So, one part of the definition is clear. Let us move on to another part, that is underlying. Now, the value is derived from the underlying asset. Let me tell you this with the help of an example. For example, if I am having a shop which is wherein I am selling cold coffees, right. So, the price of cold coffee that I will set will depend on one major ingredient, that is milk. So, can I say that the price of my cold coffee will entirely depend on the price of my milk? So, can I say this is underlying? If the price of my milk falls down, the cost of my coffee may also fall down. If it rises, this will also rise. Now, here please make sure I am barring all the other permissible attributes, right. Simply we can say underlying something that completely depends on the value, right. I hope with this example the term underlying is a bit clear. So, as we continue with the definition, it is also mentioned it can be traded on an exchange or over the counter. This is I will be taking in consecutive slide. And price derived from the fluctuation of the underlying asset. As I told you, the price of the milk goes up, the price of the cold coffee will also go up. It goes down, it will go down, right. Moving on to the next, as we can see here, the value of underlying asset actually helps you to derive the value of derivative. Advantages of derivative: hedge risks. Now, when I talk about hedging risk, here I am talking about actually not to make profits, but to safeguard yourself from any kinds of losses that may happen, right. So, it helps you to safeguard yourself with the future risks because it is a future market. Coming on to low expenses, definitely low expenses when I talk as compared to trading in stocks. So, trading in derivatives is comparatively low as compared to trading in stocks. Moving on to disadvantages, high risks. How? Just now we have read that the price of derivative entirely depends on the price of underlying asset. So, definitely if the prices of underlying fluctuates, automatically the price there will also fluctuate. So, it is high risky. Speculation, yet another very important term when we talk about investments. Speculation wherein only focus is made towards driving profits out of it. So, this is one of the major disadvantage of derivative, and that is why people are quite reluctant to deal into derivative market, because people are more focused to make more and more profits rather than providing for subsequent losses that may occur. Moving on to the next topic, participants in derivative market. As I said, now there are broadly three major participants: hedger, speculator and arbitrageurs. Now, talking about hedgers. Now, here students, remember, when we talk about the participants in derivative market, we are actually talking about their mindset. And hedger will always work or will always focus towards minimizing the risk in the portfolio. When I talk about portfolio, portfolio consists of multiple kinds of stocks, bonds, everything that will comprise of a portfolio, right. That is a very different topic, but just in short, right. So, hedger will have a mindset to minimize the risk of the portfolio. On the contrary, if you talk about the speculator, as the name implies, speculator will be involved in the market only to generate profits, right. He is not trying to minimize the risk, but he is actually here to make profits on future price predictions, right. So, there are different types of participants, one being hedger. As I said, the mindset is to minimize the risk. Second is a speculator, wherein the mindset is to generate more profits. Third is arbitrageurs. Arbitrageurs are what? They make risk-free profits, or they actually try to create more profits by entering into different markets. Just a second, let us simplify, right. Reduce losses, or I can say make profits by entering in different market. How? For example, a share, as all of us know, a share can be traded in NSE as well as BSE. Now, for example, in BSE, NSE, right, a share price, for example, let us take Reliance India Limited, a price of one share is 98, although it is not, this is just an arbitrary figure. In BSE it is at 98 and at NSE it is at 100. So, I think it is a better way that person can buy from here, that is BSE, and sell at NSE, thereby making a profit of rupees 2. This is what these kind of participants are known as arbitrageurs, who actually try to make profits from the price fluctuations of the markets. Now, just understand the scenario, what will happen? More and more people buying this and more people selling here, demand rising, the price, as of all of us know the law of demand rises, price also rises. And again here what will happen? It will go on to reduce the price gap. 90, probably it becomes 99, 100, the price gap has reduced to 1. Again, probably let us make it 99.5, 1.5, 99, it becomes 1. Here what we are doing? We are actually reducing the price gap. So, this is the task of arbitrageurs, right. So, I hope by now you might have been clear with all the three mindsets of people, or the rather, to be more specific, the mindset or the participants in the derivative market. Moving on to the next segment, we have types of derivative: forward, future, options, swap. Okay. Before I come here, I would like to take you to another one wherein I come across two important terms. One is OTC derivative market, another is exchange traded derivative market. When I say OTC, it means over the counter, and exchange traded are also known as OTE, that is over the exchange. Okay. Going back to the previous, we had forward, future, option and swaps, right. Coming on to the next, OTC mein it is given forwards and swaps, whereas in exchange traded it is futures and options, right. But madam, you only said the derivative market is future market. Yes, it is. Let us understand how. When I talk about forwards and when I talk about OTC, I will just give a very short example of the same. There is one textile manufacturer, right, for example A, alright, and there is one Mr. X who is producing cotton, right. Now, for example, this textile manufacturing firm, that is A, needs some amount of cotton to make the linens or the shirts or the clothes, whatever. He gets into a contract with Mr. X. Now, why would he get into a contract? For example, the price, cotton is generally traded in bales, okay, the unit is bales. So, the price of bale is 20,000 for one bale, for suppose, right. Then it may go down to 17, it may again go up to 25. So, there are multiple price fluctuation in the price of bales of cotton. Mr. X unable to derive much of profits because sometime it is going low, going high, difficult to understand at what price should he sell. Similar situation is with Mr. A, what to do? Better, they both came into a contract. They both came into a contract that okay, let us finalize a price that is 20,000 and you are ready to sell this to me. Mr. A says that I am going to purchase, for example, 100 bales of cotton from Mr. X at a price of 20,000. Clear? Now, for example, this extends for 3 months. This they have come into a contract for 3 months. Now, if in that duration of 3 months the price goes down to 18,000, Mr. A is at a loss, X is at a profit. Clear? On the contrary, if the price goes up to 22,000, Mr. X is at a loss, A is at a profit. What to do? Right? In such a kind of situation, there are chances, since it is an OTC, over the counter, two people sitting over the counter, either of the party may deny to execute the contract. I repeat, either of the party, either Mr. A may say that I won't continue with this, or Mr. X may say that I won't continue with this. Such a situation is known as default risk. Default risk. This happens in forward market when either of the party may deny executing the contract. That is when we talk about default risk. So, with the introduction of default risk, there was another market that came into existence, and that was known as a future market, right. Then let us understand what is a future market. Same example I am going to take, okay, Mr. X and Mr. A. There is one body in between. For example, I can talk it as exchange, not naming it anything, okay, simple exchange. Now, Mr. X sells his bales to this exchange and Mr. A purchases from this exchange. Now, apart from Mr. X, there may be Y, there may be Z. Similarly, with Mr. A, there can be B, there can be C, okay. So, there are multiple number of buyers and multiple number of sellers. So, chances of default risk is eliminated. X comes and gives the bales of cotton in the exchange, A comes and buy. Irrespective, the buyer is not known who the seller is. Similarly, vice versa, the seller does not know who the buyer is. This is what we call as future market, and that is why it is headed under exchange trade derivatives market. I hope this is clear by now. What is forwards? What is futures? We kept on listening, madam, FNO, that is futures and options. Again, right another, options is also an exchange traded market. Again, you have here two, that is call and put. When we talk about swaps, that is again an OTC derivative market. We generally deal with the interest rate swaps. Okay. Coming on to this, since we have already done with one example, understanding this would be an easy task for you. Like futures, before going to futures, let us come to forwards. Forwards are future contracts that do not trade on an open exchange. Very true, yes. Each is a custom contract between two parties. I told you they customized to a price. They did not deal with market price. They customized to one price wherein both of them were in a win-win situation. Coming on to futures, contract is an agreement to buy or sell an asset at a future date in an exchange traded market. Right? Options give you the right. Now, this is very important. Options give you the right, but not the obligation to buy or sell the stock at a strike price by the expiration of the option. Strike price is the price that has been agreed to buy or to sell. Swaps are typically used to hedge interest rate. Now, hedge, again, talking about hedge, what did we mean by hedge? Going back to this, hedge is minimizing the risk of the portfolio. Now, going on with the conclusion, as we all know that financial market has lot many ups and downs. So, in a simple terms, one suggestion is that whenever you trade with caution, as they require extensive knowledge to trade successfully. Cutting it short, it is based on the market evaluation, as we read in the disadvantages, that it is also high risk because it depends on the underlying. This is all for this part of the video. Thank you so much.